Hello, David Moore, Equity Advantage with Robert Smith of Peregrine Private Capital, and thank you for joining us today. It's January of 2023. I said 22 at the very beginning of it. I apologize. It's like I was on vacation and I hate to be back.
It's hard to get back into the grind, partner.
It is, especially when I look at my office on the water and my office in the water. No, in the waters in Oregon, by the way. So we talked a little bit about a variety of things. We're going to talk about interest rates this segment. We're going to talk a little bit about what investors' objectives are, and I think we're all sort of seeing a change there. And with this free money environment we've been in since the last crash, people got used to having no cost of capital, and they're sort of having a wake-up call there. But I'm seeing our clients, and I mentioned one earlier that just immediately comes to mind, and he was not concerned about what he's going to make on this stuff. He just wanted preservation of capital. So, what are you seeing, Bob? What are people, they're coming to you today? Are you seeing a shift in their expectations? And what do you see happening in the interest rates, their reaction to the interest rates? And obviously one of the nice things about DSTs is they're not having to go out and qualify for the money, which can be a minefield in and of itself today. And then LTVs also.
I think actually it's yet to sink in for most investors how profound the change that is taking place now is. We were all the way back in 2008, 2009 when the housing market crashed. And the then Obama administration rushed in with, I think, $800 million in stimulus, which was considered unprecedented at that time. We were anticipating inflation. And you did get a form of inflation. You got asset price inflation because banks kept the money, much of the money in-house. And so it helped begin the inflation of asset values, but there wasn't general inflation because that money wasn't distributed to the public at large. The pandemic and the trillions of dollars of stimulus that came in the wake of that was fundamentally different. That was money that was mailed directly to individuals at a point in time where the economy was already recovering. And so that has created the general inflation that we anticipated earlier. And the Fed obviously was very late to the party in recognizing that. Jerome Powell first telling us there would be no inflation, then it was no longer deniable that it would be transitory, and then he finally retired the word transitory and got about the business of raising interest rates to stem the inflationary tide. So I think it's yet to sink in with most investors how profound that change is and the ripple out from an asset pricing and appreciation standpoint. Meaning in the era of free money, you had a great deal of appreciation in a relatively short period of time with all assets, because as interest rates go down, and all they did was go down, asset pricing goes up because the pool of potential buyers gets bigger and bigger. Now the reverse is occurring. We're transitioning or have transitioned into a tighter money environment and a tight money economy, which we think is going to it's intended to kill demand and slow appreciation, price appreciation across the board, which is going to happen or will probably happen with all asset types. And it will likely extend the hold interval, at least in income producing property, because the buyer pool's obviously gotten a lot smaller.
Well, I just look at the market velocity, right? It's like everything's changing. It just takes more time to move stuff. I would look at it, and I would argue, and we've talked about it in the past, but you just look at this market since the last crash, and you look at the cost capital, you look at how when making money's too easy, bad things start happening. If you look at how many TV shows are there on flipping properties these days, right? Anybody, for a period of time, anybody could make money on it. And we're going to see that change, right? I mean, you've got all these organizations talking about flipping properties, and flipping properties is one of those things where, I mean, that was my background. I wouldn't flip properties per se, but I'd buy, fix, refi. I'd buy, fix, rent the thing out, refi it, hold it for a couple of years, and do an exchange out of it. So I wouldn't be paying those taxes. 1031 is a great tool to get me where I am today, and it's a great tool for anyone. I mean, the number of our clients over the last 30 plus years that I've seen start with nothing and accumulate a nice little life for themselves. But now you're looking at that same situation, but it's all about people's ability to make money flipping things. Can you imagine? You buy something, fix it up, turn it, you hand over half what you just made, versus hanging on to it a little while, long enough to at least realize long-term capital gains, get out of the business element, or do an exchange. But when it was so easy, anybody could do it, and we see the results of that. Now those people that were so easily making money are now going to be facing a different thing, and now we've got a political administration that say, hey, the adults are back in the room, right? Well, we're going to see that happen with real estate, but the people that are giving things up, they need a place to go. And the reason I sort of bring up that elevated, that accelerated market and the price escalations, whether we're talking about watches today or cars today, whatever it was, maybe today's not the time, but 6 months ago to buy any of these luxury items, it was hard to even get. I mean, if you want to go buy a Rolex, try to buy one new. I mean, the used ones were selling for more than new ones because you couldn't buy a new one. I mean, it's just nuts how overheated everything got. And so, with the real estate, obviously, it's a natural thing that was going to happen there. And now we're sitting in a situation, a world where people are going to have to go out and get the financing. It's going to be looked at differently. But when you go to sell something, you're going to have to look at those gains and understand what's there. Don't go away, because later we're going to be talking about something called a QOZ or an OZ, opportunity zone or qualified opportunity zone. And we were talking about the whole West Coast. You started looking at real estate values in California, somebody's primary residence, section 121 is 250 or 500, doesn't do much for people today. So that thing, we'll talk about how to apply this to mitigate some of the tax liability there. But in general, what are people's, and I talked about it briefly earlier, the one client we were working with, that he wasn't really concerned about how much he was going to make on what you were selling him. It was just he wanted preservation of capital. So is that something you're seeing today, more investors wanting to do? And for people like that, I mean, we talk about how you got into the real estate space, is sort of diversifying into real estate, then looking at it and really liking it. But tangible assets, inflationary hedges, why people might look at that stuff. And then we start talking about different asset classes you sell stuff, and diversification, not only through a given offering, but what stuff in a recessionary time, I said it, recession, what are the things that are of demand in your space right now?
Well, we've talked about this at great length. Investors need to readjust their expectations from the free money era of how much more money can I make to a tighter money era of how can I hold on to the money that I have made. So we think you need to turn off one switch and turn on the other, because in a much tighter monetary environment and going forward, to balance out over a decade of free money and near zero interest rates, you're probably going to have an environment of demonstrably higher interest rates and structural inflation. We think the likelihood of the Fed ever getting inflation back to 2% is slim and none, but a level of 4 or 5% will probably allow the Fed to pivot away from its current policy of higher rates and mitigate the recessionary pressures that are already coming to bear with all of the layoffs in the tech sector and revaluation of assets. So your mind frame as an investor should change to a longer term hold period more reliance on income versus appreciation. And if indeed we are moving into a recession, those operating assets that are fundamental to daily life, habitational assets, obviously multifamily is still very desirable, albeit still a very fully priced asset, and we think you're going to start seeing rents come down because they reach such exorbitant levels prior to interest rates going back up. But multifamily, anything that's concerned with habitation is going to continue to be at a premium even during a recessionary period. And they also, with multiple doors, they also provide you with diversification. And with relatively short lease intervals, whether it's a month, a year, what have you, assuming full occupancy, it also gives you the opportunity to increase rents with as much frequency as possible, which is critical if inflation does remain structural, because to make money, you've got to be able to keep your rental income ahead of the inflationary curve, and that ultimately might translate into appreciation. So anything with a shorter lease interval.
So you just made a very important point, and I think it's something that people are not really thinking about right now. You start looking at, so end games, I mean, obviously the DST or institutional TIC, these are end games for people. Maybe an UPREIT, which we'll talk about a little bit later, is a nice end game for people. Maybe an installment sale is whatever. But if you're selling something, you got to sort of look at what you're going to get out of it. And by the way, something people need to understand is, gain has nothing to do with profit on something. So when we're talking about, my 1031 business or the assets that you're selling, the people, my clients will come to you because they don't necessarily want to deal with the asset anymore. They don't want to deal with management, all the stuff that bundle of things that are going on. So they come to you and want that. They don't want to pay the tax. They want to go on these things. But understand that gain, even if we look at recessionary times, we might have people losing property to a foreclosure or a short sale. And they think, well, I didn't make any money. I don't have any tax on the disposition of this. Understand that in a foreclosure or short sale, the sales price of that property is really the debt on the property. So if the debt exceeds the basis, you could lose a property foreclosure and have a huge tax consequence. And we did a lot of placement during that last crash afterwards, getting people out of assets that were going away and going into some of these zero coupon offerings that you guys were working with at that point in time. But my point is that if you lose a primary residence to a foreclosure, you've got tax relief. Short sales, you're going to have tax relief. On a primary residence. Income properties, you don't. So you really need to make sure going forward that if you're giving up something in a market and you think, well, gee, in your mind you think, well, hey, I lost my property or lost my equity in the property. How can I possibly have a gain? Gain has nothing to do with profit. It has nothing to do with net proceeds. It's entirely a tax calculation. It's the difference between the adjusted sales price and your basis on the property. So you've heard me say it before. I think the most important people in your life are your tax people. So have great tax people. But understand, before you ever sell anything, don't think about the exchange. 1031 is over 100 years old at this point, and we still get calls all the time after a closing. So people ask when I want to hear about it. I want to hear about, I ideally think about the exchange when you buy the asset, but at least when you contemplate a sale, understand what your tax liability is going to be, and then arm yourself with information, knowledge. Check out our YouTube channels. You can go to type in YouTube, Peregrine Private Capital or Equity Advantage 1031. You're going to see a pile of information, a whole variety of stuff. But arm yourself with the information. Go to your tax people. Understand what your obligation is going to be. Then you can intelligently, knowledgeably go forward, and hopefully we're going to be able to mitigate any tax consequence for you. But I think it's really important for people to understand that. But that diversification, preservation of capital, you've made a comment about habitation stuff. So if I ask you, Mr. Smith, what things have the most pressure in your investment world today? We talked earlier, you talked about doors. Well, what do we mean by doors? And I sort of launched into this because if you own a big box, a big box single tenant building is a very attractive end game for a lot of people. And it's a wonderful investment till it goes dark. Or the comment you made earlier, the interest rates are changing. Rents might go down. These big companies, these triple net buildings that you're buying, they have set schedules. They're not going to amend their leases to accommodate a difference in lending costs. So what happens when these things are coming back for refinance and they don't pencil, and now you got a capital call, you got to get some more principal in there to make sure you can get because the loan to value in recessionary times, typically you have a reduction in equity, you've got a reduction in loan to value. And that is something that can be very problematic where a DST, and by the way, people, I don't sell DSTs. I get nothing if somebody buys a DST. So I have no skin in the game here with respect to where you're going with this stuff. But I just want people to understand that the DST is one of the deadly sins of a DST is recourse debt, right? So I mean it's all going to be outside that, and no capital calls also. So when you're talking about doors and diversification, you're talking about obviously multifamily, you're talking about mini storage, once again, lots of doors, you're talking senior living, once again, it might be a single asset with lots of doors.
Yeah, I think inflation, to whatever extent it remains, is not the death knell, but it's going to be very, very hard on single tenant, triple net lease assets because you're trading flexibility in terms of your ability to increase rents with that single tenant, corporate tenant for a long-term lease, 10 or 15 years. And lots of investors get a big warm fuzzy that, well, I've got a Walgreens or I've got a Home Depot or I've got this, that, and the other thing. But the problem with that is most of the value in a single tenant net lease asset is in the lease itself. And so time tends to work against you, meaning the more time that you burn off on that lease, then the more problematic it becomes for the next buyer who has to deal with perhaps re-tenanting the property, refinancing the property, and so the less it's worth. Or less it can be worth, Whereas with operating assets, meaning multifamily, self-storage, senior living, anything with multiple doors, you have much greater flexibility to increase rents, assuming full occupancy. And so time tends to work in your favor with an asset like that, because if over the investment interval you can aggressively increase rents, then that should be salutary to property value at time of sale. The opposite of what you're probably going to deal with a single tenant net lease asset. And if we're right and we're living in a tighter money world for the foreseeable future, then there's a strong likelihood that the hold interval of DST properties, or for that matter, any type of income-producing property, is going to be elongated. And so, again, in an environment like that, operating assets should work in the investor's favor, while single-tenant net lease assets may not necessarily do so. And so that's a very important distinction that any investor needs to make in terms of income-producing commercial property types. The only problem is many brokers selling income-producing properties don't understand that distinction, so they're not able to educate their investors or bring them up to speed. And so that's, again, a very important distinction that any investor needs to make with regard to property type, because the ultimate outcome can be at time of sale, can be very, very different depending on whether or not it's an operating asset or a single tenant net lease asset. And then again, in a higher or tighter monetary world with higher interest rates and perhaps longer hold periods, this may become particularly important.
So one asset that I hadn't really thought about, I haven't been exposed to in your space, is mobile home parks. So I've got a good buddy, you've met Mark, that he runs the mobile home division of a very large commercial brokerage. And we were talking the other day, and we were discussing who's buying, who's selling. Obviously that asset class is very, very high highly desired right now. And he said that the institutional world is buying up smaller and smaller parks. And so I don't recall ever seeing a mobile home park offered in the DST format. Is that because the ability of financing and lease agreements, because DST's stabilized assets going forward, right? So, I mean, if you've got something like that, is it?
No, I think it's there's a distinction to be made between mobile home parks, excuse me, and manufactured housing.
Yes.
And no, I have not. I'm not aware of a mobile home park being mainstream in the DST channel, probably because of their very small size, difficulty of financing, that kind of thing. But manufactured housing is becoming an increasingly important offering in the DST space, because as you just mentioned, institutions, particularly institutional lenders, see manufactured housing as an important part of the answer to the affordable housing issue everywhere, whether it's on the West Coast. And housing obviously has gotten really expensive with Florida, with millions of people and billions of dollars flooding in. So manufactured housing is an increasingly important part of the DST space, and you can see the financing on it tends to be very favorable, which is the banks themselves saying that they are very comfortable with this asset class going forward. So I don't think you're going to see mobile home parks per se, but I do think you will see more manufactured housing offerings in the DST space. I mean, it's pretty much a no-brainer, because you own and operate the land and the utilities and the improvements, and you collect rent, and and your tenants buy the manufactured home and bring it in and put it on the property, which is obviously not inexpensive, and it's not inexpensive to move it, so they tend to be pretty sticky tenants.
Yeah.
And so as far as I'm concerned, it's a very attractive asset class, and we'll probably see more of it going forward.
So just a quick comment for everybody on this. Manufactured home is considered personal property unless it's deeded as real property, attached to a foundation, put on the ground. So we do a fair number of improvement exchanges where we're buying property and buying the house and putting the house on the foundation, on the land, and making it real. So don't worry if something at first blush might not qualify. I mean, an improvement exchange just means we're taking personal property and creating real property out of it. So that would be something to consider if you're just thinking, hey, I'm going to go do this on my own. After you heard what Bob said about these things, just make sure that you understand when a manufactured house is real property and when a manufactured house is personal property. And with mobile home parks, obviously they're all those mobile homes are going to be personal property. So then you start looking at acquisitions, dispositions, and there's rules with respect to how much personal property can be considered in, it's something that we're restricted on the amount of personal property that would be part of a real estate transaction and still count as real property. So that's a discussion we would have with you if that was something you were contemplating, and you'd have a further conversation with your tax people. But once again, David Moore, Equity Advantage, Robert Smith, Peregrine Private Capital. Don't go away. We'll be right back. Thank you.